One thing I do not like about this stock that drew up a red flag and maybe kind of pumped the brakes here is going to be, welcome back in, ladies and gentlemen. Today we're going to do a individual deep dive into a specific stock that I was looking at. Now this stock has kind of been range bound for an extended period of time, and as I started peeling back that onion and looking into the stock, there were things that I liked about the stock and there were things that I didn't like about the stock. And most of you are going to be familiar with the brands this company has under its umbrella. It is in the soft drink business. We're going to talk about Keurig Dr. Pepper, ticker symbol KDP. Now obviously they're known for Dr. Pepper, but they also have Hawaiian Punch, Canada Dry, Sunkist, Crush, Yoo-Hoo, A&W Root Beer, Mr. and Mrs. T. So not only is it catering to juices for kids, soft drinks for adults, but then also those mixers for alcohol beverages as well. So well-diversified portfolio overall, and I do like the company because I like the Ready-brew side of their business, their Keurig side of business, where they offer many caffeinated drinks with coffee, hot chocolate, and the brands that we go to and shop at every day. And when I think about a slowing down consumer, I think Keurig is an area where we could see a lot of business picking up. While yes, it's definitely more expensive than doing a traditional pot of coffee, the instant gratification of having individual coffee cups made within seconds with still your favorite brands that you like to go to me, I think it does suit well for a slowing down consumer. Now, we talk about a lot of different things on this channel when we dive into individual stocks. Number one is, does the company have a moat or competitive advantage? Number two, do we trust management? Number three, is the valuation appropriate? Number four, does it have a clean balance sheet? Does it deploy capital well? So there's a lot of questions that we have to ask ourselves while monitoring individual stocks. That's why on this channel, I do not recommend buying an individual stock, because it is a lot of work to follow a handful of names consistently. And I always recommend dollar cost averaging into a broadly diversified index. But when I look at companies that have underperformed and that are in certain sectors that I'm actually looking at, this one is kind of hitting on some cylinders here, because we can see that a 5-year chart, the company's basically traded sideways, going from $27 a share all the way up to pretty much $40 a share, and now it's trading back down to right around $28, $29 a share. And this company has paid a dividend. First thing I want to do is get an idea where forecast is for this company. What's the sentiment around the company? We can see sentiment is around $33 to $42 being a high. I don't really find this to be a long-term thing that I look at. I'm just looking at sentiment in the short term. Short-term sentiment can move the stock price depending on how bullish or bearish people are, if the company's getting downgrades and or upgrades. Currently, the company is paying a 2.9% dividend and trading at 15 times forward earnings. They've been paying that dividend for 4 years, and they've grown that dividend for the last 3 years. When we look at margins on the business, this is where we decide if this company has some sort of competitive advantage and or moat behind it. From gross margins down to net income margins, definitely doing well better than their peers, and that's exactly what you like to see when you're looking at a stock. A gap-based, everything from a forward PE to a trailing 12-month, and we can see that when we look at both a forward PE and a trailing 12-month PE, not only do they have better margins than a lot of their competitors, but it's also trading for what I would say a reasonable valuation when we compare them to their peers. But when we do a cash flow analysis on the company, not really trading at a discount when we look at a forward price to free cash flow, trading at 15 times, while industry standards sitting at 12 to 13 times. When we look at how the company's deployed capital, getting roughly an 8% on return on equity and a 6.4% on return on invested capital. Not really impressive, but that's kind of what you see when you deal with more of these larger consumer staples type of companies. So they don't do a great job of deploying capital well. It's not like the tech sector where you're going to see crazy amounts of return on invested capital, but you want to see it above 10% ideally, and at 6 and 8%, not really that impressive. When we look at top line revenue growth, going right around $6 billion of top line revenue to $14.8 billion of top line revenue, that's very solid top line revenue growth. This company was doing 48 cents in EPS now pushing over $1.50 in EPS. So good EPS growth overall, I would say, for the company, good top line revenue growth. And historically, EBITDA margins are sitting over 20%, right around 25% EBITDA margins. We can see free cash flow took a pretty substantial hit here, going from basically 20% free cash flow margin down to 6% free cash flow margin. So that's definitely something to monitor as well. One thing I do not like about this stock that drew up a red flag and maybe kind of pumped the brakes here is going to be the total debt that the company is carrying, sitting at $14.8 billion. And we see that they're having a problem with free cash flow and not getting a high rate of return when they deploy their capital. These to me are compounding problems that I don't like to see, especially in a higher interest rate environment. You're basically getting 5% sitting in T-bills, and this company is deploying capital and hardly getting 6%. So that's not something I like to see. Along with that, you're looking at substantial debt growth here and not a tremendous amount of cash on the balance sheet, sitting at $265 million of cash. Call it 1 billion to 2.4 billion of free cash flow probably projected out over the next few years. So that's a lot of debt for a company not free cash flowing a tremendous amount. So these are some red flags here, but we're still going to plug in the numbers, kind of get an idea of what we should be paying for the stock. So when we're projecting out our growth projections, we want to see what experts are projecting out this company to do. And over the next 5 years, they're projected to do between, call it 5 to 7% growth. And in the past 5 years, they've done 11%. So I don't see anything wrong with this at all. And when we go to stock analysis, we go to forecast and kind of do the same thing here to get an idea of what growth rates are going to be. And they're kind of looking at the 4 to 5% range on stock analysis. So we're going to meet in the middle and say 5%, 4%, and 3% growth. When we look at EBITDA margins, this is a company that usually does over 20%, and they're definitely slacking here, but we're going to say 20, 21%, and 23% EBITDA margins. We're going to say they get their free cash flow, say over the next few years, they get their free cash flow kind of back to more of a normalized level. I'm looking for a 10% compounded rate of return with that 3% dividend reinvested. That gives us a 13% compounded rate of return. And obviously you can build more safety in your analysis. But for a company like this that doesn't have a lot of price action, I'm not trying to go too crazy on building too much safety in here. I probably should build a little bit more safety just because of the debt load that the company's carrying and the free cash flow issues and the way they've been deploying capital, which are all red flags. So maybe I should put another 1 or 2% safety net in there. But for right now, I'm just going to use 10% as kind of a jumping off point with that 3% dividend that's paying out reinvested. You're looking at a roughly 13% annualized rate of return that I'm trying to achieve with this investment. When we look at a multiple to EBITDA, we can see that they're basically trading at 12.9 times. In the trailing 12 month, they're trading nearly 15 times, while industry standards sitting at 12, a little over 12 times. Just to get an idea, we throw a company like Coke up there and see what they're trading for. Coke's trading for roughly 20 times and 19 times. And obviously for good reason, Coke and Pepsi are going to obviously require a higher multiple here. And for Pepsi, you're looking at 14.5 and 16 times. So I'm going to use 12 to 13 times multiple here. I think that's fair. And so when I look at Dr. Pepper Keurig here, we get a price target between $15 to $20. So, at an $18 to $19 price target is probably about where I would start getting interested in this company. And I think the biggest reason why we're having a problem with this company is going to be the debt load, because let's say they cut that debt load in half from 14 billion down to 7 billion. Gives us a jump on the equity valuation at that standpoint. Gives us a jump on the equity valuation at that point in time. So with that 14 billion in debt, I definitely think that $15 to $20 price target makes sense. So $18 to $19 is basically an ideal price target I would be looking for to start building a position. And if it got below 15, I would add into that. So really good brands. So let's talk about the pros and cons and sum this up really quick. Love the brands within this company. Obviously has some sort of competitive advantage because when we compare them to their peers, valuation is a little bit richer, and margins are a little bit stronger. So those are a few things I like. Number one, the brands are great. I think it's well diversified both for children and adults, and for people that don't drink alcohol and people that do drink alcohol. So I like the diversification within their drinking. I like the diversification within their soft drink business model. Definitely reaches a wide audience. They obviously have a competitive advantage because of their margins. When we build our safety of margin and we start looking at the amount of debt that this company is carrying, definitely think it needs to fall down a little bit more to take on the risk here, because I don't think there's a tremendous amount of upside for a company like this. So when you're looking at these slower growers that have decent moats, it's about getting in at the right price. And unfortunately, it does need to fall a decent amount for me to get interested in this company, sitting at $29 a share. It's gotten as low as $23 a share. As much as I like the brand, the company, the growth here, there's some downfalls that I look at: the amount of debt that they're carrying in a higher interest rate environment. They've been deploying capital well. Balance sheet is questionable. Cash flow seem to be a problem. So I'm starting to calculate all that in, and that's where we get that kind of $18 to $19 price target, ideally, where we average in below 15 after that. So hopefully everybody enjoyed that. That's my dive into Keurig Dr. Pepper. We will see you in the next one.